Everyone's focused on what we're spending, but the real crisis is what's coming due. A $7.6 trillion debt wall that hits this year in 2025. But it's not just a routine rollover. We're piling on new debt while refinancing trillions in a market where foreign demand is drying up, higher for longer is here to stay, and confidence in the dollar is fading. More interest, more deficit, and less room to fund anything but survival. And if you have dollars, retirement, or savings in the system, you are exposed. So what happens when the world's largest debtor needs to roll over $7.6 trillion, but the world doesn't want to lend? How does the dollar itself being at risk impact your savings? And most importantly, how can you use this information to protect yourself before it's too late? Let's get into it. According to the Treasury's own monthly statement of public debt, nearly $7.6 trillion in U.S. debt is set to mature this year, meaning that the government has two options. Option one, pay off the debt, which it can't, or option two, roll over the debt by issuing new debt at today's higher rates. Now, to be fair, most of this maturing debt, around 75%, is short-term, meaning it was borrowed mid-2024 when rates were already high. So that portion of the debt shouldn't suffer from interest rate shock too much. Not to say that there aren't other serious concerns with this debt that's being rolled over. Don't worry, we'll get to that in a minute. But when we're talking about trillions of dollars, even 25% or roughly $2 trillion that was borrowed during ultra low rates that now has to be reborrowed at rates that have almost tripled, that is terrifying. And although today it's not a question of if the United States can pay it back, at least not yet, the question still remains how. Stay with me, let me explain. It's no secret that the U.S. has a debt problem. Without sound money, such as gold, there are no fiscal guardrails, meaning it's no surprise that the dollar is following the same path as every fiat currency before it. As Ludwig von Mises, the famous Austrian economist, once said, "There is no means of avoiding the final collapse of a boom brought about by credit expansion. The alternative is only whether the crisis should come sooner as the result of voluntary abandonment of further credit expansion, or later as a final and total catastrophe of the currency system involved." But just because we've handled it so far does not mean we can continue to do so. Being the global reserve currency has bought us time, but it hasn't provided us with a permanent way out. While yes, the size of the debt is huge, it's really a supply and demand crisis. Foreign demand for treasuries has been falling for years, down from roughly 35% in 2015 to 24% today, as the weaponization of the dollar, inflation risk, and mountains of debt have made treasuries less attractive. This has spurred on central bank buying of safe assets such as gold that cannot be devalued or frozen with the push of a button. But as demand for treasuries has dropped, the debt didn't disappear. The U.S. still had to issue and sell that debt, so where did it all go? This is where it gets scary. The U.S. itself has been the ones picking up the slack, which, as you can imagine, poses serious systemic risk to all of us. U.S. households, pension funds, U.S. banks, money market funds, they have been the buyers. But unlike foreign buyers who slowly have been offloading their U.S. treasuries, U.S. institutions don't always operate that way. We just recently saw this play out with the hedge fund basis trade unwind, where hedge funds using risky leverage, sometimes 100x to make a profit off of small price discrepancies in the treasury market, were forced to rapidly dump their holdings due to market volatility. Whereas U.S. banks have the opposite problem. They buy long-term treasury bonds and have been forced to hold on to them because they're technically unrealized losses. They're declining in value, but as long as they don't sell them, everything is fine. Although we know how it plays out if they were forced to sell them, if they needed liquidity. It's exactly what happened to the now failed Silicon Valley Bank. But rather than regulate these institutions from taking on more risk or buying more treasuries, jeopardizing the institutions, the depositors, and the entire system itself, the Fed is now finding ways for these buyers to purchase more. But I guess it makes sense. Why stop them from taking on more risk when you could just bail them out anyway. That's right, the Federal Reserve has already bailed out hedge funds in 2020 and narrowly avoided doing it again a couple weeks ago, although they said they were absolutely prepared to do so if needed. And I don't think we've dodged that bullet, especially as the Fed is ramping up a hedge fund emergency bailout facility for the next time. But as for banks, the Treasury is already working on actively reducing regulation so that banks can hold more treasuries without hedging or offsetting those treasuries, because supposedly the treasuries are just so safe. They don't need any hedging, even though we know for a fact that all of these banks are sitting on massive amounts of unrealized losses. They're stuck with these treasuries. And the one time a bank did try and sell them at a loss, it revealed just how little liquidity they actually had, causing a failure. Which brings us to our last buyer, the lender of last resort, the Federal Reserve, who massively expanded its balance sheet from 2020 to 2022 by purchasing treasuries with the money printing machine. Now, over the last couple of years, the Fed has been trying to shrink or reduce its balance sheet, but they are hitting a roadblock. In March, the Fed was forced to slow its balance sheet reduction significantly, citing liquidity and credit concerns, meaning that they are stuck. This entire system that's built on easy money and credit needs more and more and more to keep running. But that's the trap, and we're already in it. The only way to attract new buyers is to offer higher yields, make it more favorable for the buyer, less favorable for us. It means it costs us more to finance our debt which keeps growing. This is the debt death spiral. We're already in it, but it could be a whole lot worse. Right now, our annual interest just to service the debt is sitting at around $1 trillion. If we have to roll over and mature $7.6 trillion, we could be looking at hundreds of billions in additional interest payments per year just to service our debt, which means we'd have to print more, devaluing the dollar further, which would destroy the little bit of confidence the world has left in this system. Tell me what you think. Do you think that this is sustainable, or do you think they're just holding on and they know what's coming and they're squeezing what they can out of it before it all crumbles? Tell me what you think in the comments below. Because this is spiraling out of control. It's no longer up to the Fed or our own institutions. Just last month, S&P Global, one of the big three credit rating agencies, threatened another downgrade on the U.S. credit. This follows Fitch's downgrade last year on U.S. credit, something that most people thought would never happen, because as the debt is downgraded, that means that borrowing costs go up because the U.S. debt is now considered riskier, meaning that those who hold it should be paid more for taking on risky debt. This is a clear signal that U.S. Treasuries, and therefore the dollar itself, is no longer safe. You know it's bad when the institutions themselves that benefit from giving a positive rating are coming out and saying, our hands are tied, we have to downgrade you. But what does all of this actually mean for you? Well, initially, there's going to be a lot more pressure. We could see a slowing economy, rising inflation, capital controls, the list goes on. But the big one is going to be people who are stuck inside the system holding their dollars. Those are going to be the people who are going to suffer the most. This is something that central banks already understand. It's why they are moving away from the U.S. dollar and dollar-denominated assets as quickly as possible without setting off alarm bells, because they don't want to be the last one holding the bag. We know the trajectory of the dollar, so do they. We've all lived it, which is why they are moving at the fastest pace in modern history into gold, real tangible assets that, again, cannot be inflated away and have no counterparty risk. Gold isn't about gaming the market or a volatile trade that you hope pays off. Gold is about opting out of their trap now and making sure you have your insurance policy in place. I talk about gold week over week on this channel, and all of my research and everything I see only makes my convictions grow stronger, that I am prepared and ready for what's coming next. There is a slow motion collapse of the dollar, but like an avalanche, it is picking up steam. And there are a lot of people who are content to be asleep and not pay attention to what's coming their way. But when it hits, they will wish they had taken action then. Now is the then. I get asked all the time, okay, Taylor, I hear you. What can I do to protect myself? Well, if you haven't already, there's a reason we have created the free ITM Gold and Silver Guide. It is an incredible first resource for anyone out there, whether you're new or you've been stacking for a long time. It has a ton of great information. All you have to do is click the link below or scan the QR code to get your free copy today. That is step one. But if you're concerned about protecting the wealth that you have worked so hard to build, you can also always talk to one of our expert analysts. Make sure you have a strategy in place, even if you have one. Get a second opinion. Talk to one of them by calling us at the number below, clicking the link in the description, and setting up a time that works best for you. Or again, scanning the QR code, whatever works. Just make sure that you're protected. That is what I care about most. And as always, I so appreciate you being here. I'm Taylor Kenney with ITM Trading, your trusted source for all things gold, silver, and lifelong wealth protection. Until next time.